Hi, this is James Zhang, and today we're going to be talking about sort of COVID-19's impact on multifamily financing. I'm going to go through some economic slides. We're going to talk about collections, yield spreads, and then also dive into sort of multifamily loans and the current environment. So we're going to look at interest rates, we're going to look at reserves, forbearances, and then I probably got 20 or 30 questions from you guys already. And so I'll answer those, but definitely people who are logged on today, definitely put your questions in the chat as we go through it, and I'll try to address those as I go through the slides. So my background, born and raised in Houston, went to school in Austin, spent 10 years at G Capital. 8 years of that was as a loan underwriter. And then the last 5 years have been a mortgage broker, doing about 800 million across 125 properties. Actually totaled it up. So if you see on the top of my screen, totally the 125 properties total about 13,000 units across the nation. So looked at a lot of transactions, and then have invested in close to 25, 26 properties across DFW, Austin, and San Antonio. So just a reminder, if you haven't signed up for our conference coming up in about 2 months, I'm essentially finding the smartest people that I know and having them speak for about 7 hours. And then we're also going to have 7 hours of networking. So definitely check out oldcapitalconference.com for more information on that virtual conference. All right. So this is the way I think about sort of what's happening. So we have COVID, has a huge impact on the economy. It's impacting jobs. It's impacting the rents and vacancy. And that in turn is affecting transactions, and then impacting when people are going to buy their next transaction. So let's go through a couple slides. I thought this was interesting. This came out of sort of Moody's, is that in the second quarter, the decline on GDP was 33%. And without the stimulus that the Fed has definitely injected, whether that's consumer stimulus or business stimulus, it would have been 47.5. So I thought that was super interesting that only helped us about 13% or so. And then everyone is sort of expecting a rebound in the third quarter. The question that most people don't know is they're going to see this rebound, and then how much longer is it going to take us to get back to sort of 2019 levels and get back to a positive, I would say 2 quarters of GDP growth is what most people are looking for. So most people, it's sort of, beginning of 2022, I think most people are projecting in terms of GDP coming back. And so obviously the GDP coming down impacted the job market. And so we saw, unemployment spike to 13, 14% and has come down. And this is definitely by market. So we're going to look at a little bit more segmentation, but I think we're under 10% now on unemployment. And so this, I thought was interesting. This came out of Reese. Reese, essentially, you can see right here, this is annual rent growth for the apartment space nationally. And you can see that, it's in that 2 to 4% range. 2015 spiked up a little bit, but, we've had a huge run over the last 10 years of just positive rent growth. And so nationally, they're seeing rents come down in 2020 about 3.5%, and then the vacancy rate increasing from 4.7 to 6.4. In 2021, they're seeing a little bit more of the same, but just a little bit milder. So 0.1% and then 6.8% vacancy. So 2022, it looks like that is where people are seeing an improvement in rents and then improvement in vacancy back to where we started in 2010. So in terms of supply and demand, I thought this was pretty interesting. You can tell, so completions is the dark blue, and then net absorption. So that's how many units were completed, but then how many were actually leased up. So the light blue is how many were actually leased up. And so you can see that the completions this year are going to overshoot the absorption, and the vacancy is going to come up. Same thing for next year. And then not until that 2022 number are they projecting completions to come down significantly and the net absorption to come back up. So like this past weekend, we talked with someone who was essentially buying, deals that are coming out of lease up right now. And I was like, how do you contend with the completions? Because you've got newer stuff down, giving a month or 2 months or 3 months free. And he essentially said, I am waiting for 2022. So they're just going to hold their nose essentially for 2 years. And then when this comes back, they're anticipating rent growth to be significant to catch up for the 2 years here. So they're going to focus on occupancy, make sure they get leases signed, but then here is where they're going to get their pop in these 2 years where absorption is going to outpace supply. All right, so I thought this was interesting. This came out of Berkadia. They actually tracked new supply, and this is for the investors in Dallas are looking at Dallas. I'm based here in DFW. And so you can see that a lot of the constructions in Uptown, around downtown, and then you can see it's really focused around sort of your major thoroughfares in North Dallas. So sort of your around the Galleria area, and then a little bit sort of Plano Richardson and along George Bush. And then you can see a little bit less. I couldn't get the whole map on here, but Arlington and Grand Prairie, there's a lot less. Irving, you're seeing it sort of in that North Irving, Las Colinas area. And then when you come up to Frisco, where I'm at, you're seeing a lot of construction along the tollway in Frisco, and then along 121 and 75. So if you look at a map, and I couldn't fit the southern and southeast portion, but there's almost no new construction in that market. So this is where the new supply is hitting in DFW. And Camden is a huge, I think they have like 50,000 units that they own and manage, and they are showing similar, in terms of starts, the US starts and completions. So you see that line coming down. So this is the completions also forecasted, and this is the market that they're in terms of completions. So they're focused on that same area. So in terms of rent growth, right? So what's this going to drive in terms of concessions? You can see that Class A is really getting hit right here. It's definitely not as high as it was in the financial crisis yet, but it's sort of starting to creep back up in terms of concessions. And you can see that the B and C, this is probably a better chart. So lifestyle this is out of Yardi. Lifestyle went from 3% rent growth all the way down to negatives. And then the renter by necessity is above. So there's still positive rent growth on that B and C stuff. And, everybody was afraid of collections. This is the August collection numbers. And essentially there's been a little bit of a, let's say, deterioration of rental collection, I would say year over year, and then also month over month. So you can see sort of June, July, August, that's about a 1% pickup. And I'm in about 15, 20 deals here in DFW, seeing about the same thing across the portfolio in terms of collections. And, here on the full month, you're still in that about 4% range overall. And so the unemployment, the additional $600 sort of went away. Now it's in that $300 to $400 range by state. And so that's what people are becoming more and more interested in. But I think they're going to probably need some sort of supplemental help here, or this number is going to keep deteriorating down. And Dallas is probably a little bit has fared better, I would say, for sure. This came out of Newmark, and it shows by city what my collections were sort of last year in the blue right here, and then what they are this year. And you can see like Las Vegas got hit pretty significantly. That's 5% down. New York is down. I think Los Angeles was the big one. So look at Los Angeles. So it was at 97%, went all the way down to 93%. So these coastal markets, I think it's a combination of people moving out of these expensive markets. So the collections are down and just skipping, or they're just doubling up. And you can see right here, New York, Los Angeles, Las Vegas, San Jose, and in Orlando, sort of on the tourism side, those are getting hit the biggest in terms of rent payments. And so, in terms of DFW, we've been pretty lucky. So DFW lost about 280,000 jobs, sort of when the pandemic hit at the very beginning. They've replaced most of them. So you can see sort of April, May, June, it's improved, but it started at 3.8 million in terms of employment and then got cut all the way down. and has come back. And so the unemployment for Dallas right now is about 8.4 in DFW. So it's in pretty good shape. And I thought this was actually pretty interesting is here in DFW specifically, a couple things. This came out of Berkadia. The Class A average price is about 188 a door. Class B, this is year to date. Class B was about 120 a door. Class C was about 97 a door. So on average, about 147,000. And another thing to look at is sometimes people get caught up in price per door. You look at price per foot as well. So Class A is about 200, Class B 140, and Class C 115. And then if you look at sales volume, number of transactions is probably representative, but Class A deals are going to be your more expensive deals, so they definitely take up a bigger portion of the market. But just the number of transactions, Class A is taking up about half. We've seen some very large portfolios on the institutional side trade this year, and so we've just seen a lot of Class A transactions trade. But this came out of Real Capital Analytics for DFW. Essentially, you can see that, the cap rate, let's say in 08, 09 was in that 7 to 8% on average. And every year since 13 has essentially come down all the way down to 5.5. And so we're seeing cap rates stay essentially flat to even down a little bit because the interest rates have come down. All right. So this is transaction volume. So in DFW, I would say it actually hasn't been hugely impacted. Like a lot of deals still got done, but look at a national basis, right? So basically Q1, you had, 15, 14, 12 billion traded. Q2 dropped all the way down to 5, 4 in Q2. And that's with Fannie and Freddie lending. So right here, that volume equates back to sort of 2011. And then here you can see sort of first half, how much it's been impacted in terms of transaction volume. So going back to Camden, I thought, all right, you've showed me all this stuff, James. Now, so where do I invest and sort of what's the timing on investment? And Camden is a pretty smart REIT, and they focus on sort of the same markets that we're in. And they look at a couple things. Number one, population growth. So where's the population growth going to be in the next 3 years? And then where's the employment growth, right? Those typically follow each other. So number one, on the employment side, Dallas, Phoenix, Atlanta, Houston, Austin. So that's sort of your top 5. And then population, very, very similar: Houston, Dallas, Atlanta, Phoenix, Washington, D.C. So those are absolute numbers. Some of these smaller markets down here like Austin, Charlotte, Tampa, Orlando, Denver, on a percentage basis, they get that high or higher than these other markets, but these are just sort of absolute numbers. And so that's probably where I would be focusing in terms of target investment market. And then, the question that I constantly get is, all right, so why are people still investing in this market? You've showed me all this stuff. You're going to show me that vacancy is going to increase, rents are going to go down. So why are people still investing? And it is the yield spread between, so if you go back to sort of 07, 08, that yield spread between the cap rate and the 10-year treasury, which is essentially a risk-free rate, was only 200 basis points. And right now, let's say cap rates are 5% on average, and your 10-year treasury is 0.6, you have close to a 500 basis point spread between your cap rate and your treasury rate. So that is why people are investing still in today's market, is the yield in comparison to almost everything else is significantly higher. All right, so let's talk about where sort of financing is in today's market. On the left-hand side, let's start with the bank recourse loans. That's about 4 to 5% today. Freddie Mac SBL is in that 3 to probably 4.5 range. Freddie Mac conventional, which is really going to be $7.5 million and higher, that's going to be 3 to 4%. Fannie Mae, we're seeing it get down all the way to the 2% range on green financing. And then depending if it's a smaller loan, then with step down, you're in that 3.5 to 4% range. And then your non-recourse bridge, this is going to be your shorter term loans. We're seeing anywhere from 5% to about 12% on a floating rate basis. So let's jump into each one of these and give you a little bit more detail. So before we jump in to each one, I wanted to note, so Fannie and Freddie put out how much volume they did in the second quarter. And look at this number, 39 billion in second quarter of 2020 compared to 34.9. So they did not break out, I don't think, in this particular one, acquisition versus refi. But I think based on the transaction volume, you could bet a lot of this was refi business that they did. And so they have been, when you look at this chart, these middle three guys, Freddie SBL, Freddie Mac Conventional, and Fannie Mae, they have basically eaten up the entire market in terms of lending. And those are the guys providing liquidity in this market. So we're going to spend a little bit more time on them because they're essentially providing a backstop right now for investors to go out and buy deals because they're providing loans right now. All right, so recourse bank loans. So this is for your local banks out there. This is going to be a lot more. Your small loans, probably 1 to 5 million, or even lower than $1 million. But this is going to be based on Fed funds rate. So when you look at the Fed funds rate, this was 2.4 back just a year ago, July 2019, and the Fed has essentially been cutting rates since then, and then took them all the way down to 0. And so we used to see deals at about 5%. Then it went to 5.5%, and now it's about 4.15. And I would say these bank loans, they are having to contend with their retail book, their hotel book, their construction loan book. And so they are not lending as they were pre-COVID. They are very, very hesitant, and you better have a good relationship with that banker, and you better have experience in that market. And the deal better make a lot of sense because these deals are actually quite difficult right now. So they're doing lower leverage deals with experienced borrowers a lot of times right now. All right, Freddie Mac SBL. So this is $1 million to $7.5 million on stabilized deals. This is priced off the 10-year treasury. These deals are still getting done. We've done a bunch of refinances on Freddie Mac SBL. Your interest rate's really driven by location, leverage, prepayment penalty, and then how much interest only you're taking. So we've done a couple loans where, let's say a $2 million loan, standard market of, somewhere in DFW, not Dallas County. And, it's 80% leverage, 125 step down, and you're at about 372. But if you, choose yield maintenance, that saves about 25 basis points. And so you're down to 345. And so Freddie Mac SBL is still a great option right now to, buy deals in that 1 to 7.5 that is stabilized. So 90% occupied for the last 90 days. All right. This has a map of some of your top markets for SBL and your smaller markets. So you can see sort of Dallas County right here in red, but then surrounding DFW is sort of back to your standard market. All right, so this talks a little bit about rates and shows you how the different options. So there's a 5, 7, and 10-year. Fixed means that essentially at the end of that 5 years, it's a balloon payment. Hybrid is actually an option where it gives you an additional floating term so that the total loan term is 20 years. And so you can do a fixed or hybrid, and then depending on the market, right? So you can see that as you increase or decrease the size of your market, the interest rate is going to increase, right? And then typically the 10-year is the lowest rate. Most people go with a 7 or 10-year on the Freddie SBL side. Understand? All right, so Freddie Mac Conventional. So this is a newer option for people. This is for deals over $7.5 million in loan amount. This is going to be priced over LIBOR. And so you're going to be at similar debt service coverage and leverage hurdles, but every tier you go down. So if you go from 80% down to 65%, you're going to save about 20 basis points. The big thing here on this Freddie Mac Conventional is that they have a floating rate product where essentially you are locked out. So you cannot do anything for the first 12 months. But then after that, you have a 1% prepay, which is significantly lower than yield maintenance. And then they're also going to look at the affordability. So we're pricing deals right now in about the 3% range. And then if you take, let's say, a little bit lower leverage, you're about 285. So this is a great option if your property that you're buying is stabilized and is over $7.5 million in loan amount. All right, so this is a big question that we've been getting a lot is, all right, so what's the reserve requirements and why do I even have to put up reserves? Well, in March, they decided Fannie and Freddie said, hey, we're going to keep lending in this market, but you're going to put up reserves to get us comfortable with collections. And so Freddie SBL is 12 months P&I. And in Freddie conventional, depending on your debt service, so if you're at that sort of 80% level, you're going to be 9 months of P&I. And then if your debt service is above 140, you're 6 months P&I. The next question I get is, all right, I put that money up. Now, when do I get the money back? And so they essentially are giving you a number. So they're going to essentially peg like your net rental collections and say, all right, after all these emergency declarations are gone, and then you will get this money back if you hit this collection number and your occupancy is at least 80%, or after the 12 months, after 12 months, then they're going to look at your collections, and if it's good, then they'll release it back to you. So it's sort of an either or on that option. All right, so I thought this was interesting. So Fannie and Freddie put out sort of how their book is doing, right? So how their balance sheet is doing. And Freddie Mac gives a little bit more detail than Fannie in the breakout. And so I wanted to talk about, so on Freddie, they're seeing about 4% of their loan, total loans, number of loans are in forbearance right now. So forbearance is essentially that owner asking, hey, I can't pay the mortgage payment right now. Can we just put a hold on it and I'll pay you back? And so they gave 3 months forbearance, and now they're actually extending it, and you can ask for another 3 months, but you have to pay that back within 12 months of the forbearance period. So what they're seeing, I think, is a lot more pressure on the small balance book. So 76% of this 1,250 loans are in forbearance, are small balance loans. So that's in that 1 to 7.5 that we talked about. It just has there's definitely more B and C properties in that small balance spot. And then, imagine you have a 10, 15 unit deal. If like 2 or 3 people move out, all of a sudden you can't afford the rent. That's a problem. So that's hit more of those tenants, and then, or more of those properties. And then also the about 20% of the book that is in forbearance, 9% is student housing. So a lot of people have kids that maybe or may not be going back to college, back on campus. So the student housing is suffering. And then also your senior housing, just because of what happened with this pandemic. There was a bigger impact to the senior part of the population. And they also made a note that, the excess, if the income did drop, would have to drop more than 10% to be under a 1.0 debt service. So I think a lot of people, there's still a lot of cushion there in their book before more loans have to go into forbearance. So here's a breakout on the bottom for Freddie Mac. And then Fannie, so if you move over to the Fannie side, they have put out a couple of changes. I would say your interest rate here is driven definitely more by loan amount. So 6 million and up is for Fannie. 1 to 6 million is about 60, 70 basis points higher in interest rate. They're also going to look at your leverage, your prepay penalty. This is the new thing. This green program came out about a month ago. And so if you get 30% total savings, so 15% water, 15% electric, you're saving about 30 to 35 basis points on your interest rate. So that is a newer thing that you should be looking out for. And then affordability is still a very big deal for Fannie Mae. So definitely take a look at the affordability of your property. We can run that for you. And then that's going to give you, it might give you 15, 20 basis points on your property. All right, so these are the rates currently for Fannie Mae, depending on your loan term. So if most people are taking probably 7 and 10-year debt right now. And then the spreads are about 2% to 2.5%, depending on your loan term. But the rates you can see are right around that 3% range at full leverage. And so that's what we're seeing. And then if you get green, so you get another 30 basis points off of that rate, you might be in the 270 range on the green side. And so this is on like a 10-year property, 10-year loan. So similar to Freddie, this is talking about Fannie Mae reserves. So Fannie Mae reserves, they had everything, right? So they had P&I, they had taxes, insurance, and replacement reserves in March when it rolled out, and they had it for 12 months, and they have scaled that back. So on 6 million and above, you're at 12 months P&I, and then you have 9 months to hold that. And then if you're below the $6 million amount, it's 18 months P&I. So we just closed the deal in Phoenix last week, and it was here at the 65% lever, and it was 6 months of P&I, and then 9 months they're going to hold it. So the exception on these is if you do a loan assumption, it requires no reserves, but if you take that supplemental, it's going to have the same reserve requirements as this above. So basically they're telling you don't take the supplemental right now. So Fannie Mae, they're a little bit broader in their forbearance stats. So they provide it more frequently, but they don't give as much detail. So right now you can see, when we started in April, it was about 29 loans. June, July, it sort of topped out 286, so 1.3% of the balance. And then in August, we're down to about 4 billion, so 1.18 of the total loan amount. So wrapping up on the non-recourse bridge side, these are typically for not stabilized properties. So you might be 60, 70% occupied, and then your loan amount is really going to drive your interest rate on these. So 1 to 5 million, there's really not that many non-recourse lenders out there. So your interest rates are going to be about 300 to 500 basis points higher. So let's say on this example one, you have experienced borrower, $12 million bridge, you're probably 5% all in on a floating rate basis. So LIBOR plus 400 to 500. But then if you drop into that $4 million loan, you're going to be a LIBOR plus 7 to 900 basis points. So 8 or 9% all in. So probably back 2019, there was probably like 20 bridge lenders out there who were willing to do deals, and now there's like 2. So the field has shrunk significantly. So they have a lot more requirements to get your bridge loan done right now. All right, so I'm going to open it up to Q&A. If you guys have any questions, definitely put them in the chat, and I will start going through them. And so Vivek asked, are you seeing collections vary significantly by class of property? So I actually read a little bit about this, and so most of my deals are probably A- to C+ in that range. And what I'm seeing is the A- stuff, as long as it does not have ground floor retail, it's been a lot better. So I would say they're probably 98, 99% collected on the A- stuff. On the C stuff, it is definitely slower. C, you usually took the whole month to collect already, and now you're seeing it trail. It's probably in that 94, 95% range. So you're seeing probably about 3 to 4% difference in bad debt on the A versus the C stuff. All right, Layla asked about cap rates, and then so cap rates we are seeing compress significantly, even from where they were. So we used to see a range probably of about 5% to 6% on cap rates. So 5% for A, 5.5% for B, and 6% for C. I would say everything's shifted probably about 50 basis points down. So in the last couple of months, when a lot of deals have come out, A's are probably now 4.5%, B's are probably 5%, and then C's are probably about 5.5% here in DFW. Any other questions? Go ahead and put them in the chat. I received probably 30 questions from people beforehand who had registered, so I'll just start going through those. And okay, so Chris B asked, fixed versus floating. Why not float and put interest rate caps the next few years? I agree. So Freddie Mac, since they've come down on the, I would say quality scale a little bit. So they're looking more at B and C deals. As long as they're 7.5 million, you can do a floating rate loan on them. I think that makes a lot of sense since interest rates are not expected to move up significantly. If you can do a floating rate loan on Freddie Mac that has a longer term. So most of the time, the concern with floating rate loans was your interest rate and then also your maturity. But if you can cap the interest rate and then also push out the maturity for longer than 5 years, I think that's a win-win. Tina asks, can I get financing without prior multifamily experience? Yes. The easiest way is to partner with someone else who has experience, and then you are presented as a group, and then you get sort of that other person's experience shown onto you, and then you get the deal approved. If you don't have prior multifamily experience, they're going to ask you about your other business experience, your other multifamily, your other maybe single family experience, and then you're going to need third-party property management for sure. And then instead of 80%, let's say loan to value on a deal, you might be at 70 or 75%. And if I was buying a deal without prior multifamily experience, I would focus on sort of your primary markets. So we showed that map earlier for Freddie Mac. I would be focused on your primary markets. All right, Tina, you are on. Great. What is the average equity you have to give a KP or co-sponsor to partner with? And so this really goes back to 4 things that I like to talk about when partnering with somebody is that you usually, let's say you have 20% to you, the sponsorship group gets 20% of the equity. Now you have to decide, all right, how much of that 20% do you get and how much do other people get in your KP group? And I always start with the number one important thing is the deal. So there's 4 things: the deal, there's prior multifamily experience, there's ability to raise equity, and then I would say those those are the 3. And then the 4th one is net worth and liquidity. So if out of those 4, the more that you have, the more that you can command as a co-sponsor, right? So Tina, if you, let's say you find a deal, you can raise the equity and you have the net worth and liquidity, and all you're asking for is for that person to sign on the loan because they have multifamily experience, then to me, you're probably getting 75% of the sponsorship, right? So if you're doing 20%, then you would get 15, the other person would get, let's say 5% of the equity. But then let's say you just found the deal and the other person's bringing multifamily experience, they're raising the equity and they're bringing net worth and liquidity, then you might only get 5% of the deal. So it's all negotiable. It's all dependent on who has the most leverage on the deal. So that would be my response to that. Jeff, so when do you expect good buying opportunities and what to look for? So, you know, there's always good buying opportunities. I would say if you want to have the market in your favor, you know, I think most people are underwriting at least 1 year of negative rent growth. And then 2022, everyone has it sort of popping back up. And so I think that's probably where it makes more sense. So I like to see 2 quarters of positive GDP growth. So once we see that, and then maybe even 3 quarters, and when we have a vaccine, then you're going to have a little bit more runway in terms of buying opportunities. But, you know, right now, if there's a big deterioration in collections at a couple properties or people aren't able to reinvest into their properties, then I think there's going to be opportunities. But I think if you want just like the market at your back, it's probably 2022, my guess is, based on what we're seeing right now. Ravi asks, how are multifamily prices post-COVID compared to pre-COVID? They're about the same, actually. They're down maybe 1 to 5%, but there is no 20% discount right now on pricing, because a lot of deals that came out in January, February, they essentially put them on hold, came back out this summer, and essentially at the same whisper. They might be down a little bit, but not much. What you're getting is really a discount on your debt. So your debt, it was probably, let's say 4%, 4 to 5% on Fannie Mae, and now it's 2 to 3%. So you're getting about a 25% discount on your debt. And so that is what is driving the amount of people buying right now. All right, Nelson, what's going on with cap rates? So we showed the chart. Cap rates, I would say, are about, you know, in DFW used to be 5, 5.5, and 6. Now it's probably 4.5, 5, and 5.5, A, B, and C on cap rates. And that's, I would say that's probably in sort of those markets that we showed earlier where, you know, have population growth, have employment growth, are business and landlord friendly. Those cap rates are staying there. In the markets that, let's say on the coastal markets, where it is not landlord friendly and there's rent strikes and people are protesting, like those cap rates are going up, right? So I think it's very market driven on those cap rates. Mike asked, is COVID affecting lender due diligence timelines? Everything is still going. Everybody's still using about a 60-day close. I would probably do a 15-day extension at a minimum, just in case it takes a little bit longer. I would say everyone's working from home. Everyone's got used to working from home, so I think that's still happening. I think Fannie and Freddie are just similarly overloaded with deals right now, especially on the refinance side, and so it's taking a little bit longer than usual. But I still think a deal can get done in 60 days on the Fannie and Freddie side. All right, Blake, in your opinion, are we in more of a seller or buyer's market at this time for Texas and for the greater US? I would say it's still a seller's market right now, because when we look at deals, even listed deals or even off-market deals, there's still 4 or 5 offers on these deals. So there's still a bidding war to some extent. I would say there's more of a bidding war for deals that are sort of stabilized with upside. And for Texas, I would say it's a buyer's market in those areas where there's being a bigger push in terms of where on the coastal markets that are more expensive. That's definitely become more of a buyer's market if you're willing to step into those markets. Alan asked, agency versus non-agency financing, given the risk, potential risks like the CARES Act. So what Alan's referencing is that essentially if you had a agency loan, they said, hey, because of the CARES Act, you can't evict anybody. And so somebody will say, let's say like a bridge loan, they could evict someone, quote unquote. But a lot of municipalities, a lot of places were just closed or didn't even, you could file the eviction, but then the cop wouldn't go there and kick them out. So it didn't really work. So that wouldn't be a reason to do non-agency to me. Agency loans right now have the best debt in terms of interest rate, in terms of leverage, in terms of IO, in terms of amortization. So even though you have to put up reserves, I think that's a smarter way to go right now if your deal qualifies. Lindsay asks, we are new to multifamily investing. Should we reach out now or wait till we have a deal? I'd say reach out now. Let me know, what you're looking to do, what's your target investment market, and then let's start building the team, right? So let's start figuring out where you need help. And so what KPs do you need? What listing brokers do you need to meet? And then let's figure out what can you qualify in terms of financing. So definitely reach out now. Gijo, are you seeing sellers reducing price expectations? I would say, going back to the other question, no. They are coming down a little bit, maybe that 1% to 5%, but not overly, the 10, 20% that people potentially were expecting. All right, so let me go back to the chat and see if there's any more questions. Okay, Tina asked, is there, so you're saying, all right, I've been asked to join as a KP on these non-recourse loans. And then, so why do you need a guarantee if it's non-recourse? And the reason is that the loan can turn recourse, right? So if the loan, there's a list of probably 15, 20 things that if you do as a general partner, then the loan becomes recourse. Some of those things are, let's say you get insurance on your building and then you get proceeds from it, but you don't use it to rebuild the building that you got, the insurance proceeds, or you don't do timely reporting, if you don't keep up the property in terms of inspections, in terms of things like that, or you just provide false information to the lender, then that loan can turn recourse and then they can go after you as the guarantors. So be careful on who you sign with. All right, next question, Anon asks, volume of deals closing, and then has this been the same? So I would say the acquisition volume is definitely lower just because a lot of people pulled out in the second quarter. But I would say towards the end of the second quarter, a lot of deals came back on the market. And so we're seeing a lot more deal activity now, and then a lot more refinance activity because the price of your debt has gone down. So if you have a 1% prepay or a step down prepay, a lot of people are just refinancing right now just to sort of reduce their monthly expense on the debt service coverage. And then also, extending the term, right? So if you have a loan that's maturing in 2 or 3 years and you're thinking, all right, let's just push this out a little bit, I'm going to hold this deal, then that is something people are looking at. Next question is around net worth and liquidity requirements of sponsors. So the net worth of the total general partnership group needs to be equal to or greater than the loan amount. And then the liquidity total of the group needs to be 10% of the loan amount or higher. So the post-close liquidity is after your down payment, how much money do you have left in cash, in your checking, savings, or marketable securities accounts? All right, so next question, Luke asked, where do you see interest rates going in the next few years? I would say flat. It can't go down much lower, but I would say flat in the next few years. That's what the Fed is impacted. And then not until they really see a lot of economic growth are they going to raise interest rates. Ed asked, how do I get started? And that's a little bit more of a longer answer, but I would say definitely start sort of start building your team around all the players that you need in this multifamily investing game. And then start leaning on those people to start understanding, all right, if I were to buy a deal, that's the question I usually like to ask is like, if you had to close a deal in 60 days from today, who do you need right now? And if you don't know that person, start to know that person so that when you do have the deal, you're ready to go. Stephen asks, how do you calculate yield maintenance? My response to this, so yield maintenance is a prepayment penalty that Fannie Mae has on their loans, especially the larger ones. And this is driven by essentially you pay the interest for the remaining term of your loan. But they take the present value of that. So go to defeeswithease.com and you can plug in your loan information and get that. Yesenia asks, what areas are you investing in? What class? So I'm mostly in Texas. Those are the areas I know. That's where I was born and raised. And so those are the areas I'm investing in, sort of Dallas, Austin, San Antonio, Houston. And what class? I'm really focused in sort of the A- to probably C+, B- space right now. Vivek, can agency loan interest rates go lower? So agency interest rates are based off of two things. One is the 10-year treasury, and then the other one is a spread over that. And so 10-year treasury right now is, let's say, 60 basis points. And the spread, let's say, is 2 to 2.5%. So you're all in at, let's say, 3%. Right now, Fannie is putting a floor on the treasury rate. So they're using 90 basis points as their floor. So even though 10-year treasury is lower, they're still using that floor. So even if interest rates, if 10-year treasury goes lower, let's say it goes all the way down to 0, Fannie still has a floor on it. So your rate can only really go down is if the spread goes down from it. All right, 2, if I'm new, how should I prepare my financials? Best advice is send me an email. I can send you sort of a personal financial statement and sort of plug it in there. And that's how you'll prepare your financials, and we'll go through it together. Kelly, reserve requirements. So we went through that in detail. And then when will they be released? So it took them about 3 months of good collections before they took off the taxes, insurance, and replacement reserves. I think it's going to take a minimum of at least another 3 months. So maybe August, September, October. It hopefully will be released, but they're doing well. They're doing so much volume, even with the reserves. So think about it from the lender's perspective. You're doing a ton of volume. You have reserves, and nobody out there is really lending. You're just going to keep the reserves on there because it makes the loan safer. It makes it better for their investors. Derek asks, are deals close to asking price? I would say yes. If you are way off on your asking price, you might be 5% below, but you cannot be way off or you're not going to win a deal right now in today's market and in competitive markets. Mike asks, what are funding requirements and how have they changed? Same requirements, sort of net worth and liquidity are the same. So net worth equal to or greater than the loan amount, and then 10% of the loan amount in post-close liquidity. All right, Nate says, as more people flock to real estate and have more cash, how do you stay ahead of others? I would say your network of people that you know. So if you are looking, let's say, for a deal in Dallas, who are the general partners that you know that already have access to deals, right? So, or who are the listing brokers that you know that are going to have access to deals? That's what I would be focused on. is, being ahead of those people. Because in this game, actually, we are financing deals anywhere from $1 million all the way up to, let's say, $20-30 million. Like in this game, everybody has money. And so it is not really the money part of it. It is more the relationships, and people know that they're going to close on the deal. Tra asked, how do I enhance the chance of getting approved for a loan if I'm new to multifamily? I would say set up a meeting beforehand with someone like me, a mortgage broker who has done a lot of these loans, and we'll review sort of your resume, what you have to bring to the table, and then what potential other deals are the people you could partner with. Cornelius, how do you qualify for the best interest rates? I would say Fannie and Freddie have the best interest rate right now, so you need to make sure you qualify for Fannie and Freddie right now. So let me see if there's any other questions here. All right, people ask, does the liquidity include the amount that you put up in reserves? No, it is separate. So it's actually what is sitting in your own personal account. In terms of liquidity also, so think about liquidity as, if I told you to go get the money right now, could you get it? Could you write a check? Could you go withdraw that money? And if there's any penalty to getting that money, then it's not liquid, right? So if it's sitting in a 401k account and you got to pull it out and you got to pay a penalty, early withdrawal penalty, and pay taxes on it, then that's not liquidity, right? So it is stuff that you can go out and get, right? Because Fannie Mae wants you to have liquidity, because if another COVID hits or something like COVID, and all of a sudden you need to pay your debt service, then that is what they want. So that is why they want you to have liquidity. So think about it that way. So we're gonna wrap up. Just a couple more questions here. All right, Ivana asks, what should I consider when underwriting in this market? How much do I need to put down? So most people are putting 25 to 30% down right now. Most deals are in that 70-75% range. In terms of underwriting, unless you're bringing a deal way up to market, I would say probably flat rents that first year, and then going forward, 1 to 2%, unless you have sort of a huge value add play that you're considering. Kara asked, when should I use bridge versus long-term? Are people getting rehabs funded? So bridge, shorter term, 3 to 5 year holds is when I would use bridge. And if it's more of a stabilized deal, do the long-term financing. And if people are getting their rehabs rolled in. So Fannie Mae, they're going to look at your in-place debt service. So you got to make sure that even with your rehab rolled in, you can still cover the debt service on the loan. Aaron, any change in appetite for rate caps? So when you go get a floating rate loan like a Freddie conventional, then you have to go out and get a rate cap. And so most of those are priced off of LIBOR. Plenty of people on the LIBOR rate caps. The new transition from LIBOR to SOFR. On SOFR, there's not as many rate cap providers, so they're still working on that. But they'll have it set up before they even roll out a deal on the SOFR side. Availability of bridge loans, I would say it's down significantly from 2019. It's definitely going to hopefully improve over time. And, what's happening is that these bridge lenders who are in the market, they are charging a higher interest rate. They're doing lower leverage, and other lenders are seeing this. And so once they see that, they're going to start coming back into the market. But right now they're pretty limited. BHS, does third-party management check the experience box for Freddie SBL? I would say it checks it like halfway, right? So it's a requirement. They're going to have third-party property management if you've never done a multifamily before, but they're also going to look at other things, right? They're going to look at, are you local to the property? Do you have any previous business experience? Like, did you run a business before? And, sort of what's your experience in that? And they're probably just going to do lower leverage is what it's going to come down to. Erickson, best way to find partnerships. I mean, we mentioned our conference. That's one way. Another way is to go to these meetups, and start sort of researching some of these people. I mean, now is the time, right? So whether it's podcasts, YouTube, conferences, I think there's a lot of different ways to do partnerships. and start figuring out how to set up Zoom meetings with these people and start meeting them and going and see their properties. Daniel, when is the most ideal time to purchase a multifamily property? What about as prices are decreasing? I would say, yeah, if you can wait, right? Yeah, let's wait till 2022 when the market's coming back up. But then if you have an opportunity to buy something and you can underwrite lower rents for a couple years and then come out the backside and there's no competition on the deal, then this might be your chance to jump in. So, I think long term, multifamily is a great investment. So I think it's always a great time to buy. You just have to make sure you buy at the right price and underwrite it correctly. So I like this question. Linda asked, what are the anticipated / unanticipated challenges, opportunities within the next 24 months? I would say anticipated, I think everyone knows that collections are going to be harder with the amount of unemployment that we have. And so I think that is an anticipated challenge going forward. I think some of the opportunities are really around this whole virtual piece. And before you needed, 2 or 3 people in the leasing office to show people units, but now people are looking at the units virtually. They're signing leases virtually. And so I think there's definitely more opportunity on that property management space going forward. So I think hopefully you can run your business better as well too. Requirements for GPs signing on the loan. So I actually saw this on the chat as well in terms of credit scores. Most of the time they want sort of 650 to 680 or higher in terms of GP signing. You really want that net worth and liquidity of the loan amount with the fewest number of general partners. And then the general partners, they're essentially going to ask you to do a credit authorization. So that is, basically running searches on you for bankruptcy, foreclosure, any litigation against you. And then GPs, if you sign on the loan, they're going to ask you probably for an annual personal financial statement, schedule of real estate as well. So those are some of the requirements of signing on the loan. So here is the Freddie, Fannie requirements one more time. Definitely check out, if you haven't seen our conference website, check that out. I mean, these guys, I'm basically calling these guys and telling them, asking them to come on to the conference. So these are guys that you definitely don't always have access to. So if you can make that event, that's a great event. And then look, if you, want more information, definitely subscribe to the YouTube channel that I have, like the video when it comes out, but then definitely if you have questions about a deal, right? So send me T12, trailing 12 financials, rent roll, offering memorandum, and sort of how much you think it's going to go for. Let's take a look at it. Or if you have a deal that someone sends you and it's like, I don't really know all that much about this deal. James, what do you think? You can just send it over and I'll give you my comments on that deal. And then really to get started is completing your personal financial statement and setting up some time to go through the deal together, and whether you're buying, selling, or refinancing the deal. So that's it. Thanks for joining, guys.